This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Thursday, July 18th, 2013. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I'll pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month focuses on the regional macro economies. Therefore, the slides this morning will focus on the other three report areas: global risk updated 2 months ago, the macro situational updated last month, and the U.S. economic development to be updated next month. I want to tie them together in a discussion of what I see to be today's globalization trap: an exposed capitalist system, a growing failure of economic growth, a brewing financial storm, or I should say storms, plural, fermenting social unrest, and the earmarks of a globalized liquidity trap which we have never seen before. And I think anyone who spends time reading and watching global economic events unfolding today senses that something is terribly wrong. We are tinkering with something that is structurally flawed. No one seems to have a clear vision of what is to be done to get things back to the way they were, or at least into a fashion we feel things would be more stable and sustainable. Unrest, uncertainty, and fear seem to fill the air and certainly dominate a lot of the discussions I find myself listening to. So what is wrong? Globalization and the pursuit of economic growth has led to both global imbalances and global distortions. Imbalances in trade, current accounts, balance of payments, currency reserves, distortions in interest rates, currencies, pricing, standards of living, all have led to what must now be clearly seen as a looming global crisis. Witness the EU and the peripherals, Japan and Abenomics, the US slowdown, and now China and the BRICS and emerging markets feeling the slowing rate. It seems the list of serious problems is endless for those who actually follow these developments closely. What is happening, and how do we make sense out of it? Let's walk around this cycle, which I call the globalization trap. First, pursuit of real growth. Every country you consider today is looking for economic growth. Even China is now feeling the pressures of slowing growth rates. On the top right, we see labor arbitrage. I think it is safe to say we have experienced a paradigm shift since the late 90s, as over 46,000 U.S. manufacturers alone have left the U.S. looking for cost advantage through labor arbitrage. Overlay this with the advent of the internet and its incredible creative destruction of the nature of work and labor utilization, and you have a recipe for a shock. A shock that we don't fully understand or grasp yet. Then look at goods and services per unit labor cost. I am certainly no communist, but I read Karl Marx as a young man and completely rejected it. However, his research did point out potential flaws in the capitalist system. They sounded academic at the time, but now they may not be, at least one. My co-host at Macroanalytics, Charles Hugh Smith, recently reminded me of one of these. Marx expected capitalism to experience a series of ever larger boom and bust cycles that would eventually precipitate revolution and overthrow the existing financial political order. His thesis was based on one of the drivers of these cycles, or one of the drivers, was the interplay of increasing production and declining labor costs. Simplifying greatly, Marx recognized that industrial capital, as opposed to financial capital, could only increase profits and accumulate more capital by raising productions and or establishing a price-fixing cartel or monopoly, or what I often call today crony capitalism. But mechanization characterized industrial capitalism in the late 19th century, and Marx observed that as mechanization increased productivity, the marginal value of labor decreased on a per unit basis. So what does that mean? The bottom line of this is that real disposable income eventually contracts. The middle class engine of your society is slowly and steadily gutted. Any of this sound familiar? Then you look at the rate of aggregate demand growth. What happens is the rate, and let me stress, when I say that, we're talking about the second derivative here, the rate. So of aggregate demand growth falls. To stimulate growth, we then expand money and credit, since this is the accepted solution to cyclical adjustments. But this is not a cyclical problem. It's a secular structural problem. So forget for a moment the whole notion of marginal propensity of that expansion of credit to actually achieve anything. And that's a discussion I think I've had before for our longtime subscribers. But consider it in a different context here this morning. Consider the definition of a liquidity trap. And let me define it. And this is just one definition, but a generally accepted one. A liquidity trap is a situation described in Keynesian economies in which injections of cash into the private banking system by a central bank fail to lower interest rates and hence fail to stimulate economic growth. A liquidity trap is caused when? Three areas. One, people hoard cash because they expect an adverse event such as deflation. Two, insufficient aggregate demand. Or three, war. Signature characteristics of a liquidity trap are short-term interest rates that are near zero. We have that, yes. And fluctuations in monetary base that fail to translate into fluctuations in general price levels. We have that, yes. So if you look at the velocity of money chart, Fed excess reserves and falling capex, and you can see we have fear and hoarding. We may not have war, but the bond bubble has been a fear trade where people after 2008 wanted the return of their capital versus simply a return on capital, and therefore were willing to accept next to nothing in real terms on their yield. It became a yield chase at very low levels. But the bigger issue is aggregate demand. It simply isn't there at a sufficient rate, and it is not going to come by increasing money and credit. It just isn't. I can put a tooth under my pillow and wish all I want, but the tooth fairy is just not going to show up. This is not a fairy tale, but reality. A reality our society is unwilling and unable to accept. It will take a crisis and a market-clearing event to reset the mechanisms and restore growth. We must correct the mispricing and malinvestment before investment will return. We have so much spin and deception going on that it's truly hard to sort the wheat from the chaff. Governments, the GDP, the employment, the inflation numbers, they're all just out and out bogus. And I've written and done tapes on this many, many times if you want to check the library. It's very clear whether we get into hedonics or any one of the statistical mirages that are currently being used, and the most recent being imputations. You got corporations where the bottom line earnings are so massaged, you need to be a forensic accountant to understand what is on the balance sheet and what is off. But somehow the bottom line is always met, though the top line is falling, and margins themselves will soon be a shock. Markets, well, can we believe those? We got dark pools, high frequency trading, and you just don't know what something is really worth. Gold is so manipulated that physical and paper prices have no relationship any longer. The media, it only matters what sells advertising and supports their stakeholder needs, not what the actual stories or facts are. Reporting has nothing to do with the news, and fair and balanced investigative reporting, but it was nothing more than advancing a position. So what do you believe to assess and sort through what I'm calling this globalization trap? I think you'll look at what people haven't yet started manipulating. Let's consider three of these. There are a number of them, but three of them that really are easy to see. Capital expenditures and investment, actual cash flow, and actual government entitlement payments. These things are pretty straightforward, and see if we can learn anything from them that supports this trap. But before we do, let's just take a quick look at global growth. This is a chart from The Economist. It severely understates the problem, but even then says there is one. Global growth is steadily falling. Note that it is almost nothing if you take out the BRICS. Talk to the individual BRIC countries today about their growth expectations. The Economist estimates that world growth slowed to 2.1% pace in Q1 2013, down a full percentage point from Q1 2012. The high-income countries are barely growing net-net. Europe is largely in recession. U.S. growth in Q1 has been revised lower again. The prospects for Q2 look poor. U.S. growth has not improved, though the Eurozone contraction may have eased. It still appears to be contracting. Japanese growth is likely to pick up, with both exports and domestic consumption continuing to recover, but Abenomics is a recipe for disaster in the long term, so I just can't imagine that this is going to end very well. Emerging markets often grow faster than the high-income countries, though it does not always lead to superior asset returns. The BRICS have slowed, as have other emerging markets. The sharp rise in global interest rates starting in late May will not help matters. The increase in interest rates is not a reflection of greater demand for capital due to increasing activity. Rather, the rise in rates reflect portfolio adjustments in response to the tapering talk. The U.S., less stimulus is not the same thing as no stimulus, continued selling of foreign assets by Japanese investors and the liquidity squeeze in China. Nothing says wealth to me like a luxury Swiss watch or two. And I thought this was just a really good real-world example. And despite the equity markets of developed wealthy nations resurgent in their inflated asset-based selves, it seems the demand for luxury watches remains subdued at best. Spot the diminishing returns of wealth effect, or can the wealthy actually have too many luxury watches? And where is the growth? While Asia appears to be a big drag, Europe and the U.S. are also plunging, but have no fear as Africa's sales are up 25%. There's the real wealth effect. On small numbers, I guess anything looks good. The wealth effect plan appeared to be working until the beginning of 2013, when in spite of the almost unprecedented and exorbitant rise in equity, Swiss watch exports collapsed to their worst level since the Great Recession. Transitory blip? Doesn't seem that way at the most recent year-over-year change is the worst in 6 months. Consider cash flow, or EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. This is the basis for value investing and determining enterprise value. This is growth about to go negative. It's clearly global across all sectors. Corporations are hoarding capital. Remember that word hoarding? How? Here's the capital expenditure charts. This is a long-term trend which is only getting worse. They can't find, the corporations, sufficient high-quality, or for that matter, even low-quality growth investments, organic growth investments. They can't find sufficient numbers of them. When corporate capital investment slows, bad things happen. Jobs aren't created, money isn't available in disposable income, we don't have aggregate demand growth, we pump out more money, and here we go around the cycle again. This is a long-term chart of retail sales. Let's talk about consumption. Growth is not showing negative here, but I have noticed in my area locally the closing of Borders bookstores and near-empty parking lots, as a lot of the big box stores and malls are definitely down compared to how they used to be, just as an observation on volumes. We're overstored, and sales growth just doesn't support it. The rate of growth of aggregate demand is decelerating. There are 200,000 unemployed globally who can and want to work, but don't have jobs. The participation rate tells the real story. In the U.S., the labor force participation rate, the size of the labor force, as a percentage of the national population of the same age range, has been sitting right at 63.5%. This continues to be well below pre-recession highs and is a major U.S. concern. Nevertheless, it continues to be much higher than in many other parts of the world. Job growth is insufficient, and without middle-class spending, aggregate demand simply isn't there. But it is worse than this represents. There is a huge difference in a quality job and the standard of living it supports, and a job that isn't of high quality. The most recent jobs report was anything but strong, despite the hype. It was just another edition of the born-again job scam that has been fueling the illusion of recovery during the entire post-crisis Bernanke bubble. In fact, 120,000, or 62% of the June payroll gains, consisted of part-time jobs in restaurants, bars, hotels, retails, and temporary agencies. The average paycheck in this segment amounts to barely $20,000 per year, which is sub-poverty level income for a family of four, and compares to upwards of $50,000 per year for goods-producing jobs in the BLS survey. Altogether, the government has reported 2.8 million of these part-time job gains since the Great Recession officially ended in June 2009, accounting for a predominant share of the ballyhooed pickup of 5.3 million total jobs. What matters are aggregate dollar earnings. On that front, the Commerce Department figures for total private wage and salary income are just plain bunk. Nearly 6 years on from the December 2007 peak, real payroll disbursements are still down by nearly 1%. This is not a cyclical problem. This is a structural problem. Entitlements, I mentioned those. There are 116 million Americans with full-time jobs according to the BLS, which includes 21.9 million government workers. I don't want to disparage government workers, but they're not productive. They do not add to the productive nature of the country. We can't get by without them, but it's still a drain on it. It's an expense, if you would. Now the flip side, showing how many Americans are reliant, for example, on the USDA's Food and Nutrition Services Program, or food stamps, or on the disability payments, i.e. food assistance in some form. There are 47.5 million Americans now on food stamps. There are 30.4 million Americans participating in the National School Lunch Program. There are 13.2 million Americans participating in the School Breakfast Program. There are 8.6 million Americans participating in the Special Supplemental Nutrition Women, Infants, and Children Program participants. There are 3.4 million Americans participating in the Child and Adult Care Food Program and the Food Donation Program. There are 0.6 million Americans participating in the Commodity Supplemental Food Program. There are 0.1 million Americans participating in the Food Donation Program. There are 8.6 million Americans on disability, for a grand total on just these items, of 112.5 million Americans on food assistance. End result, there are 3.5 million more Americans with full-time jobs than there are Americans who are relying on government for their daily bread. I think that works out to a 3% delta. What this means for the country and the aggregate demand that I was talking about, well, I'll let you decide. Where does the demand come from when you got this, other than the fact that food stamps accounts for 14% of the grocery store sales? All of the above is leading to ever-increasing social unrest. Today it is Egypt, Brazil, and Portugal. Yesterday it was Cyprus, Greece, and Spain. It is global in nature and intensifying as the global liquidity trap tightens, and few see a clear way out. We have debt saturation that cannot be sustained by a present global growth and aggregate demand growth. Money and credit creation is not the medicine for this problem. In fact, it is the poison, and this will eventually be understood as the monetary malpractice currently being prescribed comes apart at the seams and we experience an inevitable fiat currency crisis. And we have talked about this on numerous occasions previously and what I mean to that. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments are, there has seldom been a better time for investing. However, it requires careful analysis, and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and very well-informed financial advisor that you trust. So until we talk again, may 2013 be an outstanding investment year for you. Thank you very much for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.